ever work with a financial advisor who was not meeting your expectations, or you want to learn how to evaluate the financial advisor that you have? Keep listening to find out what we think about financial advisors and how we vet them.
Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Alicia Taylor.
And I'm Dr. Brittany Halford.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time.
It's that time of year where residents are graduating, Leisha. And one of the things that I remember doing this time of year is getting my own disability insurance policy.
Yeah, me too. Me too. It's so crazy because I don't know about you, Brittany, but it wasn't something I wanted to buy. It was just something that I knew that I needed. One of the most important things that we should do as doctors is secure our income. And so we need to make sure that our high income as physicians is protected.
Yeah, and most physicians forget this step. They think that they're going to an employer that offers disability insurance, so they don't need their own independent policy. But let me tell you, no one cares more about your money than you do.
And oftentimes residents have access to these guaranteed standard issue policies or special rates and discounts that other people, even outside of training, cannot get. And so you want to make sure that you're going to somebody who can get you the lowest rates possible, as well as getting a tailored policy customized to fit your needs.
And Leisha, I found that PKA Insurance Group, Pradeep Auto, and Matthew Peterson, who are independent brokers and focus on disability and life insurance, have provided exceptional customer service to ensure that your policy is customized. They look through every single thing, and I really appreciated that there was no lapse in communication. They would allow me to ask questions and provided me with options from different carriers, and were really focused on what I needed.
Yeah, and they were efficient, honey, because look, I am busy. I do not have time to sit on the phone and do 20 Zoom calls. And so one of the things I really like is that if you're healthy with limited to no medical issues, approval is likely in 5 minutes.
Yes, there are discounts, as you mentioned, on disability coverage, and they can range from 10 to 40%, depending on your situation. So if you are someone who's not gotten their own independent disability insurance policy, then please reach out to PKA Insurance Group to discuss your disability or life insurance needs today.
Yep, and that's www.pkainsurance.com or call 1-800-258-1018, or you can email info@pkainsurance.com. Wealth-minded MD listeners, Brittany and I are so excited to let you know that our Negotiate Like a Boss Accelerator is now open for enrollment.
In the accelerator, you will learn what to ask for and the exact words that you need to say during your next negotiation to be successful and secure the bag.
Yep, that's right. Our latest client got over $15K more in salary, along with less clinical time. Wouldn't you like to do the same?
And Leisha, what I love about our program is that we have this practice session where we put our client in the hot seat as if she were actually sitting with her boss and negotiating. And what she said about that session, that it was the most effective for building the confidence, not only that this is possible, but that she too can be successful during negotiation.
Yep. She really did love it. And I thought it was great too to give her some real feedback. You know, you were the tough boss. I was the one providing the feedback. And I think it was really helpful for her. But she is not alone in that. I think it could be helpful for some of our listeners as well. And so if you are listening to this podcast, you are in the midst of a negotiation or thinking about negotiating because you're like, hey, I could use an increase in salary. I need to increase my pay. If you're having those thoughts, you can click the link in the show notes to sign up for our Negotiate Like a Boss Accelerator, and we would be happy to help you. All right, Brittany, what is going on over there with you? You seem a little frazzled, so I'm just wondering what's going on.
Oh, Alicia, I was thinking, should I tell her this offline or if Should I tell her on the mic? So we're going to open this up on the podcast. People, get ready. Have your listening ears on. Because we are so knowledgeable about finances, like we have made financial mistakes, we have read the books. It sometimes is challenging for me to accept mediocre help from financial professionals.
Loaded. Okay.
Girl, so not only that, and I don't want to say that everyone is this way, but there are some people who are in our financial space who have provided assistance or what they deem as assistance that is not very thoughtful to us. And one of the things that I've been working on personally is just how to be a more tactful, polished person in general and how to not come off like I'm from Flint, Michigan, from the hood. And today, girl, during this conversation with a financial advisor, I had to apologize because I felt like I let Flint Town Brittany out on this man. And I know he was like, okay, we have an unhappy client here. And I was like, yes, you do. So the story goes is we're using a financial advisor to help us with one piece of our financial portfolio, which is a cash balance plan that we use to put more money away from for retirement, specifically for my husband's business. The performance is supposed to be targeting about 4 to 6%. However, when I looked at the performance, it was basically about 1%, not even matching inflation. And so as I'm talking to him, he mentions, well, the reason why you're using this account is for the tax savings, not necessarily for the performance. And I had to clarify quite nicely, taking a couple of deep breaths, that there are other ways that I can reduce my taxable income without paying you 1% of the assets under management. So please help to clarify what your strategy is because this is an investment account. Like you are an investor, right? You understand that the goal is to have a return on investment, and this is the targeted return. And honestly, the account that I'm managing are not performing as poorly as you are. And so I said, so why will I pay you for underperformance? I didn't say that calmly, but that's essentially what I said. And he's like, I get the message. I understand what you're saying. I'm going to go back to the advising team and say we have an unhappy client and what is going to be our strategy moving forward.
To your defense, I could completely understand why you might be frustrated in this situation. And I think it speaks to one, how knowledgeable about finance you are. Because I venture to say that there are people who listen to this podcast or other podcasts who have hired a financial advisor and maybe they didn't know how to vet or evaluate his or her performance. And so they don't even have the knowledge to then say, it looks like my portfolio is underperforming. Is there a reason for the underperformance? Can you please justify the fee that you're charging me for that underperformance? Right. So a lot of this speaks to your knowledge and is a lesson for all of us listening to your story of if we've got somebody that's managing all of our finances or an aspect of our financial life, we need to make sure that we're vetting him or her and evaluating their performance so we can know whether they are worth keeping or not keeping. So part of this speaks to how knowledgeable you are. So I want to commend you for your knowledge and actually checking up on this and saying, hold on, let me see how this specific investment has performed this year. And so that's number one. Number two, I think it probably is a great opportunity to enlighten our audience on what a cash balance plan is, why you have it, and more importantly, why the target is 4 to 6%. Because there are some people listening to this that are like, Brittany, 4 to 6% is low. Why would you target a low performance? Why do you even have this? You're doing this to save taxes. I don't get it. I want to be frustrated with you, but I'm sorry, I just don't understand what you're doing. Let's start with the basics, right? So everybody can understand your frustration. What is a cash balance plan? Why do you have it? Why did you set the target the way you did?
Yes. So a cash balance plan is essentially a defined benefit plan. Think of it like a pension. You will make contributions into this account and because it has a defined benefit and I think the IRS restricts this that the defined benefit as calculated in the plan as by the actuary is 4 to 6%. I'm just going to be honest with you all. I have not read through all of the IRS regulations and stipulations regarding this cash balance plan or cash balance plans in general. But as it has been outlined and explained to me that there is this target of benefit. And this is a plan that my husband uses for his private practice as an employer plan offered for an employee benefit that you can get this 4 to 6% targeted benefit for contributions. So the reason why we use a cash balance plan is because it allows for us to reduce our taxable income on the business side that is passed through to our personal taxes. So it basically is a pre-tax account that we can put money into, and it will give a defined return or a benefit, and that money will be shielded for taxes. Now, as far as cash balance plans goes, you can put a lot of money into cash balance plans. There are some logistical things with looking through the plan, like anyone who works over 1,000 hours, then they get this benefit. So we have to be very careful about who we accept as employees and all of that. But essentially, the reason why we have the plan is one, because it allows us to make retirement contributions into a plan that's going to be tax deferred. It allows us to put in money today that is going to allow us to reduce our taxable income. And because it's an account in which we're investing in, it allows us to get a small conservative return on investment. So those are the three reasons why we are using the account. And you could put a lot more money into the account than you can into a solo 401k or a SEP IRA and things of that nature.
Yeah. So, in case you missed it, this is another kind of account that you can utilize to not only build wealth, but to also reduce your taxes. And so, there's two kinds of retirement accounts, if you will. There are defined contribution accounts and there are defined benefit accounts, right? So, a defined contribution account are things like a 401k or 403b. You put a defined contribution. The limit for employees in 2025 is 23,500. So, there's a certain defined amount that you can put into that account. And then you have defined benefit accounts. So with that account, it's not like you have a certain amount you can put in. It has a certain amount that it needs to be able to pay out in retirement. And so because you have to guarantee a certain payout in retirement, you need to ensure you have the money in the account. And that usually means that you cannot just invest it in risky investments, right? Because there's a chance that you may lose the money. So you have to be more conservative with the way that you invest the money in that account. And you've already mentioned, Brittany, that in this specific account for your husband's business, they've defined an amount or percentage of growth each year, 4 to 6%, right? That's enough so that your portfolio is gaining in value each year and keeping up with inflation, ideally, but not so much that you're taking so much risk with the money. And then you mentioned the benefits. It's another account. You can stuff more money in there for retirement. And the biggest benefit, I believe, Brittany, please correct me if I'm wrong, is that all the money you put in there is shielded from taxes, right? So if you put $50,000 in a cash balance plan, that's $50,000 of reduction from your taxable income. And some of these plans, depending on how old you are, they might allow you to put $100,000 in there. When we compare that to a 401k or 403b, you're comparing your 23,500 that you can put in there as an employee into those kinds of accounts with potentially 50,000, 100,000 that you can stuff into a cash balance plan. And so I get what you're saying. You're like, Alicia, of course I got this account. We're putting all this money in this plan and we don't have to pay taxes on any of the money we put in there. And so it's a great way to kind of drastically reduce your taxable income and still allow your money to have some sort of growth in the account. And what I'm hearing you say is that, Alicia, this thing is supposed to grow by 4 to 6%. And I'm a good enough investor. I can make a portfolio grow by 4 to 6%. I could probably make it grow by more. And so I'm wondering why this person I'm paying is performing substantially worse than I am, because there are some underperforming managers. We need to make sure that we rectify the performance. I have a question for you. Is there a reason why you couldn't just put the money in bonds? Bonds will secure you 4 to 6%, or leave the money in cash right now, put it in CDs, invest it on I know for these plans, you need an actuary to basically tell you how much you can put into the plan each year. And they kind of modify the investments and things like that so that it fits into all the very strict IRS rules. And so often for these plans, people do hire help. So you're correct in hiring the help. I just wondered if you couldn't just dictate the investments yourself and say, I want to put it in bonds or something like that.
That's a great question. See, we're on the same wavelength. I love you, Alicia. During 2022, 2023, when CDs were offering about 5%, and I looked at the portfolio and I said, hey, why are we so broadly diversified? Why are we investing in these high expense mutual funds that are essentially eroding the returns when we can simply put this money that I am not looking to use in 3 to 5 years in a CD? And they gave me many reasons. Well, with that, you don't have the flexibility of buying and selling. With that, you might have more or less returns. With that, it locks your money up for 12 months or 9 months. And I said, I'm not accessing this money anyways. Why would I subject it to risk when I'm looking for this low return? And they said, let me get back to you. I'm going to consult the advising team. And for 2023, that's what we did because I suggested it. Now, those CDs came to maturity and I did not follow up with them afterwards. So they just went back to their usual thing of investing the money. And it was just recently, and this is partly my fault, right? This is not something that I was actively monitoring because I'm looking at the solo 401k, I'm looking at our IRAs and doing all of those things as well. We had to call the account, make sure that Kevin could give me access and give him all of these things. Nonetheless, I finally got access to it and I reviewed it again, and that prompted the meeting. So, to your point, there are other strategies. They're just choosing these very high expense mutual funds, choosing small cap companies, large growth companies where they can create a simple strategy. Like sometimes simplicity is the better approach.
You know what? I agree with you. And in fact, for some folks that I know who have these cash balance plans, they'll just do a conservative investment of 50% stocks and 50% bonds. And they'll invest the bonds in a total bond market or a TIPS fund or something like that. And TIPS stands for Treasury Inflation Protected Security. So that at least part of their money is increasing with inflation. And then 50% in like total stock market and call it a day. And so I wonder, since you seem to be unhappy with the service that you're currently receiving, one, if you might shop around and see if you can find a better manager that won't charge such a high fee. And two, if you can get them to simplify the investments into a strategy like that you can kind of take forth and use long term. So I wonder if that might be potential solutions for you. But I don't think that the onus is on you. Yes. Could you have checked in and seen how they're investing it? Yes. But I don't think that the expectation is that we pay for help and then we micromanage who helps us. Or at least that isn't my expectation. Right. And so I'm like this at work and I'm like this in every aspect of my life or in most aspects of my life. Right. If you ask me to do a job, I'm going to do the job. And I will probably get annoyed if you micromanage me. And so I know how I feel with that. And so I try not to micromanage others. If I've given you the task, if I've delegated that to you, I expect you to do your job and then come back to me with the results. Or if you're having issues, then notify me. So could you have checked in with him or her? Sure. Do I think that that is your job considering you're paying somebody to take care of that for you? No. Again, lesson learned for all of us that sometimes when it comes to these financial professionals, we need to check in with them. We need to vet
Mhm.
them. We need to evaluate them. And we can't just assume that they're doing what's best for us.
I wholeheartedly agree with that. And one of the things that I asked him at the end of the meeting, because he didn't have any answers, I'm just a little perplexed. I primed this man and I said, hey, because he called me about something else. I said, hey, I want to schedule a meeting to talk about the performance because from my very cursory review, it looks like it has not been growing much. And my question is why? So I gave him a 3-week lead time for him to do his due diligence, look at my account, and go and talk to the financial advisors to come back with a strategy. He did not do any of that. So that part of me is a little bit frustrated that I gave you the expectation that this is what I wanted to talk about. And I think he was under the impression that I was not as knowledgeable as I am because he starts the conversation explaining what's the difference between active and passive. And I listened because I didn't want to be rude, but I wanted to tell him, like, hey, at some point I just interrupted him, like, thank you for going over all of this, but listen, this is what I'm concerned about. So I think moving forward, I want to see what he has to offer, what his financial advising team suggests as an offer, because I also accept that there are many things that I do not know. And there are many things that other people know. Even if they're underperforming in this regard, I could still learn something from them. So I'm curious to understand their approach to mitigating this underperformance and what they have as a suggestion, because there might become a time where I think we're actually going to close and move our money to somebody else, so I'm shopping around for another financial advisor, or we might just close the cash balance plan, roll into a solo 401k, and I can manage it myself. And then we'll just have to figure out, okay, where can we help from a tax perspective side so that we can still not pay the fees and guarantee higher performance in the solo 401k instead of this restricted, more conservative approach in a cash balance plan. So there are many thoughts going through my head, but I just am not 100% on what the next steps will be just yet.
You know what? I think that's really interesting. Do you know, Brittany, if you could have a solo 401k and a cash balance plan?
You can. So you can have a profit sharing solo 401k with a cash balance plan. It is different though with the amount that you can put into the solo 401k. So it is usually 6% of your income. I thought it was net profit, honestly. So I'm verifying that because I just had to clarify that with someone and I did not look it up to confirm my thoughts. But nonetheless, it's like 4 to 6% of either your net profits or your net income for that you take. And my husband has S Corp. And so not all of it is salary. Some of it are distributions. I mean, we can get into all that stuff later. Nonetheless, it's 6%. So it's a much smaller amounts that you can put in. And so we have the solo 401k, we have the profit sharing component that I am managing.
So there's a smaller amount that you can put into the solo 401k if you have both. There's a smaller amount that you can put into the cash balance plan if you have both.
No, solo
Ah.
401k if you have both. So it's a profit sharing solo 401k and it's restricted to about 6% of what I thought was net profits from the company
Okay.
that you can
Okay.
put in. Mhm.
As physicians, one of the most important things that we can do is make sure that we secure our income because a lot of our financial plans are contingent on our high doctor income. One of the things that you will need to do is make sure that you get long term disability insurance.
Now, Pradeep and his team at PKA Insurance Group have a reputation for putting people over profits and always doing what's best. Do not hesitate to email PKA Insurance and his team today.
They will help you get the insurance you need with the service you deserve. For this financial focus and for our listeners, I think it would be good to kind of go through some tips, if you have any, Brittany, from this experience for what our listeners can kind of take away from this when working with financial advisors. I sometimes give tips, but in full transparency, I don't work with a financial advisor. I have found, similar to what you found, is that oftentimes I get frustrated in these meetings. They are underperforming per my standards and also underperforming for the market. I could invest this myself and we could get much better returns. If they were giving me above average returns, I wouldn't mind paying above average prices or just paying for their help. But if I'm paying you and you're doing things worse than I am, I'm wondering why I'm paying you. And so I oftentimes get into these meetings and I, similar to you, am frustrated. I, similar to you, find that people are talking to me in a condescending way as if I don't know information that I already know. I'm trying to balance efficiency with please don't tell me things I already know, with me trying not to be rude and interrupting them, as you also shared. And then when we go through the investments, I'm wondering why this, why this, why this. And often the person I'm speaking to cannot really defend themselves and they need to go talk to other people. And then that makes me wonder, well, why am I not talking to the person who's managing my money? And so, similar to you, I get very frustrated and I'm just like, I'm going to just do it myself. And I find that to be the case that oftentimes, and I've told lots of physicians this when I'm speaking at groups and things like that, I'll get this question of, Leisha, what question should I ask the person that I'm working with? And how do I vet a finance professional? And oftentimes I will tell them is to be really honest. Once you get to the point where you can vet somebody very well, you are probably at the point where you can manage it yourself and do a pretty good job. And I have found that to be the case. You're nodding, so I can see that you found that to be the case. But just tips for our listeners, like if they are working with a financial advisor and they don't know if that person is underperforming or overperforming, how can they figure that out?
Yeah. So I want to take a step back because I think sometimes I criticize a lot financial advisors, and that's not the stance that I want to come from because I think that they have a purpose and a place. Just explaining for us, this cash balance plan was something that we had not done before. We opened this up about 5 or 6 years ago. And at that point in time, I had never really thought about utilizing a cash balance plan. So there was a level of a lack of confidence, basically, that I had about doing it ourselves. So I think that's where the financial advisors really help medical professionals in how they leverage and sell to us is that we get to do this so that we focus on this part and then you focus on your career. And for me, that was a valuable component is that I didn't have to manage everything. I didn't have to discuss with the actuary or with our tax accountant about all of these things. Like they were communicating between themselves. And I had the expectation that it was just being done on our behalf with growth. Well, first, I think having a financial advisor that is fee only financial advice would be the best approach. They can help to instruct you on how how to do things, look over your entire portfolio, look over what your goals are, what your debt profile is, what your net worth is, and help you to determine what are some smart moves for you, then that would be the best approach. Just to pay them a set fee, one and done, and then you do it yourself. Or maybe you do it a couple of times a year or every quarter. But if you're hiring someone to invest for you, I think having a discussion with them about what do I do when I have a question? Who do I contact? And who will be the person that will respond? And who's the party that is responsible for those investors? Because within a financial advising corporation, there is a structure, at least in my experience, that there's a person who is interfacing with you, who's doing the client acquisition, who is also doing the client check-ins, but that's not the person who is making the decisions regarding the investments. And so if you are someone who really wants to understand the thought going into that conversation, then I would ask whoever you're speaking with, because it's probably not the financial advisor. During your calls, you can have the financial advisor, or before your calls, if they can prepare something specifically for you with a portfolio outlining all of those questions that you have. And that is really going to be key so that you can make sure that you get your answers. And then I would ask, what is your approach to managing expenses? Because that's going to be huge. And I think a lot of them used a lot of the actively managed accounts where the expenses are much higher. And that impacts the performance. And then you can ask, like, what are some of the largest funds that you all are investing in and evaluating those yourself? I think that that is very important. And that's where this financial advisor kind of took me, where we're using this fund, we're using that fund, and this is what it does, and blah, 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 blah. So, what is their approach in general? And then, what does the typical portfolio look like? Is it mostly large cap? Is it large growth? Is it small? All these nuances, how much bonds, like, how do you figure out that percentage? I think that that could be helpful.
So, Brittany, I think that that's fantastic. And just to reiterate that, because you just dropped so many gems that I think our listeners could benefit from, is number one, ensuring that the person you are working with is fee only. And understand that there's another term called fee based that sounds very similar, fee only versus fee based, but is very different. Fee only is they only are going to charge a certain fee based is they're going to charge you a fee, right? Or a commission based on the different investments, plus they make money in other ways. So is it just a set fee, or is it a set fee plus some other pricings, right? You want fee only, not fee based. You also mentioned clarifying the lines of communication. Who is going to be the person that I contact if I have a question? And how can I expect that person to get back to me? Can I expect a response in 24 hours or 48 hours? Like, who is my contact person? The next thing you talked about was who's the person who's managing my investments? Because you mentioned in your experience, the person who you contact is not the person who's managing your investments. Meaning, in your case that you were talking about earlier, you were in a meeting with somebody who then said, oh, I got to go back to the team and the people that are in charge and making the investment decisions. Ideally, the person you're speaking to is the person who's managing it, and him or her can explain the way they have your money invested. But if that is not the case, which is sometimes how it runs at some of these larger places, you need to figure out, okay, who's managing it? And then who am I contacting? So fee only versus fee based. Ideally, you want fee only. Clarifying the lines of communication, right? Who do you contact? Clarifying who is in charge of making those investment decisions. And then some different investment specific questions that I think are really helpful that I want to emphasize because I think they're so important. Number one is, how does your firm minimize expenses? They may say things like, my advice is free. Yeah, your advice is free, but the things you're choosing for me to invest in are not. So how are we minimizing expenses, right? Because there's an expense from buying the thing, right? If you want to buy a particular stock or an index fund, there's a cost to that. But then there's an expense ratio, which is like another fee you pay to even have the ability to buy it in the first place. So how is your firm managing expenses? Another thing you talked about was, what are the sample ways that you're going to invest my money? Give me a sample portfolio. Like, what are the things that you typically invest in so I can look them up on my own and do a little research and ask you questions about it. And then I would add one question that I find is really helpful, especially for people who already have a financial advisor and you want to vet or evaluate their performance, to say, what returns did I get on my money this year? And how does that compare to the market? What is the overall return? In your case, it was 1%. So understandably, you were displeased. And so what was my yearly performance? They might say, oh, your yearly performance was 6% or 7% or 4% or hopefully better than 1%. But what was my performance? Tell me that number, that percentage. And then let me know if that is above or below the market. What I mean by the market is the average. In investing terms, usually we take the average of what people would get from like a total stock market index fund. So if you're not sure what the market is, you want to make sure they're telling you accurate information. You can just Google total stock market index fund yearly return, and a percentage will pop up. Maybe it was 12% last year. So when you're speaking to your financial advisor, you're saying, did my portfolio at least meet the average? Did my portfolio at least increase by 12%? And if it didn't, you can ask them, is there a reason my portfolio underperformed? Is there a reason it didn't meet the average? Because if you're paying somebody for help, you want to at least make sure they're doing average work. If they're not doing average work, you want to ask why. Why did I not perform, or why did I not meet expectations? Because what happens is a lot of these financial advisors get a percentage of assets under management. And so if your portfolio went up by 5%, but your advisor charges 1%, then really your net profit was only 4%. In your case, Brittany, not to throw salt on the wound, keep throwing it, girl. Your portfolio only went up by 1% and the advisor charged 1%. So basically you gained no money this year. When if you'd invested on your own, I'm sure you could have done better than zero, girl. We didn't even keep up with inflation. I could have done better keeping that money in a savings account. You're not in your head head and laughing and also basking in the reality that is your situation. So I understand, but I think our listeners can take away from that is really having this meeting with your financial advisor and not just waiting till tax time or till the end of the year, but having ideally quarterly meetings with him or her, checking in. How is my portfolio doing? What are the things you have my portfolio invested in? Is there a reason I'm invested in all of these things? Is that above the market or below the market in terms of performance? And why? And just getting that information. I think when you come from a place of curiosity, you'll really know. And I always like to tell doctors because they tell me all the time, Leisha, I ask these questions, but I don't understand what they're saying. And I
Mm,
go, you are so smart. You got through medical school. Like, are you kidding me? You are one of the smartest people on this planet. If you can't understand what someone's saying, it's because they're not explaining it very well. You're a smart person. So I always tell people, and I live by this mantra, you really know you understand something when you can teach it to somebody else. That's how you
mhm,
know you understand something. If a financial advisor is talking to you and he cannot explain things to a level that you can understand, it means he doesn't know what's happening or he doesn't understand what's happening. Because if you really understand something, you can explain it to somebody else. You can answer their questions, you understand where they're coming from, and you can at least defend yourself and explain yourself. But if they're talking in all these financial terms, just stop and say, I'm not quite sure I understand. Do you mind explaining that further? What do you mean when you say this? What do you mean when you say that? And then clarify. Sometimes I will often say, for my own understanding, this is what I think I heard you say. Can you let me know if I got that right? What I think I hear you saying is this. And I'll reiterate some version of what they just told me. And I'll say, is that right? And just clarify because I want to make sure at the very least, if I'm paying someone to do something, I understand what they're doing because they're handling my money. I want to make sure I know what's going on. Again, you'll be surprised the amount of doctors I talk to and they don't know what their money's invested in. They don't know how it's invested. They've not vetted their financial advisor. Maybe they had a conversation when they first hired him or her, but they haven't checked back in and looked at the performance. I mean, they'll probably log in and say, okay, I have more money this year than I had last year. But in terms of determining if their investments are at least meeting the average, they haven't done that. They have no clue. And so I
mhm,
would like for our listeners to be informed, to be better than that, to say, okay, I may not have the confidence, Leisha and Brittany, to manage this myself. I may have to hire help just like you did, Brittany, and that's okay. There's no shame in that. But if I'm going to hire help and pay somebody, I want to at least make sure they're doing a good job. So let me
mhm.
ask them these questions that y'all told me. I'm gonna write them down. He only versus fee based. Let me ask my financial. Let me see what he is. Who's the person that's managing it? Is it the person I'm speaking to or not? How are they managing my money? Let me write down the funds I'm invested in so I can do a little research and see if I have any questions. Let me ask them how they're managing expenses or minimizing expenses. So I'm not paying so much in fees. And then lastly, let me have them give me a percentage of my performance. Is my portfolio increasing by 7% or 6% or 10% this year? And let me compare that to the market and see where my portfolio aligns. So those are some tips that at least I have. You have any additional thoughts, Brittany?
Yeah, the only thing that I want to say is I love that question about a comparison to the market. And I also want to add that when you ask these questions, come from a position of curiosity because now you're going to be more informed. So they don't expect for you to come with these questions. Let me just put that out there. Like they do not expect for you to come with these questions. So I think part of it is how do we deliver the questions? And that's where I had to pause and apologize to the financial advisor because I was a little frustrated, especially given my knowledge that the delivery was not something that I really wanted to represent. So when you're asking these questions, you just have to understand that now you're going to put someone in this defensive position, especially if you ask about your performance to the market. And I find that that's the question where they become most defensive. And the response that I typically get is, well, we also help to protect and shield you from the volatility in the market. So although we don't meet the same performance returns, that is because you would also have the same amount of losses during downturns. That's the typical response that I hear from advisors. Nonetheless, they should be able to explain how you are protected and what percentage of your assets are in bonds and more conservative and all of those things to really justify that underperformance because sometimes it is unexplainable from their perspective. And if they explain it and cannot back it up to justify the underperformance, that could give you pause of, okay, do I need to seek out another financial advisor? Do I need to manage this on my own? And what are going to be some of the things that I personally can do with my money to produce a better and more desirable outcome.
Thank you for bringing up the typical response because I'm not aware of the typical response because I do things myself. And usually, the way I get in meetings, we don't get to that part. So I appreciate your insight. And I think to go along with that, just to give our listeners even more tools in their toolkit that they can use, I like the fact that instead of just saying, did my portfolio underperform or overperform compared to the market, by also asking that follow question that you mentioned, Brittany, was, can you tell me what percentage of my money is in bonds or bond based index funds? And what percentage of my money is in stock and stock based index funds? Because they should be able to tell you, oh, we do a 90-10 split. It's a 80-20. It's 60-40. They should be able to tell you what the percentage in stocks versus bonds. And then you can compare that to some of the typical tools. When I'm teaching physicians, I usually tell them that a lot of the online calculators will use a formula of 120 minus your age for the percentage that should be in stocks. And so if you're 30 years old, 120 minus 30 is 90. So the portfolio is typically 90% stocks and 10% bonds. Again, that formula is 120 minus your age. And so if you are 40 years old, 120 minus 40 is 80. So the portfolio typically is 80% stocks and 20% bonds. So that's usually how it goes. Some people will use a more conservative estimate and they'll use formulas like 110 minus your age or 100 minus your age, but that just gives you some guidance. If you didn't choose how you wanted the money in your work retirement account to be invested, and it's invested in a target date retirement fund, which is the default option at most employees or most places, they use that formula. Target date retirement funds use the formula 120 minus your age for the most part, just to give you some guidance on what is the norm. Is you're talking to your financial advisor and he says, oh, we're protecting your money from downfalls in the market. So we got your money in 30% bonds and 70% stocks, and you're 30 years old and you're like, huh? I thought I should be in 90% stocks and 10% bonds, right? Then you can have some comparison. Okay, they're really not positioning my portfolio for growth. That kind of gives you some more tools in your toolkit. So again, instead of just that comparison to the market question, also asking what's the percentage in stocks versus bonds? And then you yourself can compare that to what the general averages are.
Thank you, Alicia. That's extremely helpful. Each person seeks out their financial advisor for different reasons. So just keep your why as that North Star because you have most of your money in stocks and you're looking for ways to diversify your portfolio or to balance out your portfolio or protect some of your assets. Whatever the goal is, keep that in mind when you're evaluating your performance. Well, Alicia, I just want to say thank you for talking through this on the mic with me. I felt quite bad, just at how aggressive I think I was at one point in time because I was upset. I don't think he was meaning to try to talk down to me, but that's how it felt with some of the explanations and talking about the tax benefits. And I'm like, well, there are other ways that I can do that without paying you. I'm paying you for nothing then if it's only for the tax benefit. So you really want to make sure that you understand why you're doing this because there are going to be many excuses in some regards, reasons, justifications that might be thrown at you. And you want to be clear on what you're using them for and to ensure that you're holding them to that standard.
I like that. To validate you, I think you were validated in your feelings, right? Your portfolio is underperforming. And I think that you have credence to feel disappointed by their work. So I want to validate your feelings, even though you acknowledge, okay, my feelings are valid, but my approach could have been better. Lesson learned for all of us. As you can tell, I'm sort of on the same wavelength you are when it comes to this stuff. So this is one of those do as I say and not as I do kind of moments because I definitely could use some improvement in that area as well. So thank you for taking one for the team and being transparent with your moment of growth.
Always, always.
All right. All right. So, what is something fun that you were doing with money?
That is a good question. Okay, so recently I got my hair done. I typically pay to get my hair straightened or to put it in braids like extensions. But when I took out my braids, I hurt my finger and I realized that I couldn't braid, I couldn't twist, I couldn't do anything. So I had to seek out some assistance. And so they twisted my hair up. I got a great wash, deep condition, and twist. And I'm someone who can do my own hair. So this is a style that I could have created myself. But it was very relaxing just to sit back in the bowl and they used the tea tree oil, whatever, to feel the tingle on my scalp, to be able to sit there and scroll on my phone or respond to emails with someone actually taking care of my hair, even if it's a style that I can do myself. So that's how I'm spending my money for fun. And I'm just grateful for the time saving. I got to respond to some residents and do a few other things that have been on my to do list during this time.
Oh, I love that for you. I love that for you. I too went to the hair salon to get my hair washed because the person who washes my hair is different from the person who braids my hair. Long story, but I'll spare everybody. And so I was going to the salon to get my hair washed because whenever I have these certain hairstyles, I like to get like a deep condition and like a steam treatment and a protein treatment just to like revitalize my hair. And so I was doing this and I was talking to my hairstylist. She's scrubbing my hair and I'm relaxing just like you were. I'm nosy at baseline. So I'm asking her what she's got going on this weekend. And she said she was doing aerial yoga. Have you heard of that, Brittany?
I don't know of aerial yoga, but I've heard of the aerial piece where they're like on like strings or rope or yarn. I don't know, girl. Explain it to us.
Yeah. And so she explained it to me, which is why now I think I'm going to spend my fun money on it. But it is basically a mix of traditional yoga with Pilates, with dancing and the use of a hammock. So if you've seen those photos of these long, it looks like linen sheets and like cloths or whatever, and people have their body twisted up in it and they get
Mhm.
themselves on that air. Yeah. So that's kind of what aerial yoga is. And I thought, oh, that sounds so cool. We have that in Atlanta. And she's like, yeah, girl. She's telling me the studio. And I'm like, oh, I got to get my girlfriends together. We could do that. Now, I don't know if we're going to be flipping upside down and twisting in hammocks and all that kind of good stuff, but I just felt like it would be a fun bonding experience. I need some more girl time. I haven't spent as much time with some of my close friends because I've been traveling so much. So I want to reconnect with my friends in Atlanta. And I thought, why don't we schedule some time for some aerial yoga? And so I think that that is something I'm going to try. Even if we're unsuccessful in doing the aerial yoga, at least we'll have some fun and funny memories to create with each other.
Yes.
So that's what I'm going to do.
That's so fun. You'll have to let me know. Anytime it requires me to use my upper body strength, I'm like, oh, I don't know. So you'll have to let me know how it goes. I like different forms of exercising. You're right. It makes it interesting and you get to spend some time with the people that you enjoy.
Will do. All right. Hopefully you got something out of that episode and we cannot wait to come back to you again next week.
One of the most important things you can do is ensure you have long-term disability insurance. Long-term disability insurance secures your income if the unexpected happens and you are unable to work due to medical illness, chronic conditions, or an accident.
Unfortunately, all insurance agents aren't created equal. Some of them are so focused on making a sale that they fail to reveal certain necessary information, tell you about discounts available, or clearly explain the process. Pradeep Bhato and his team at PKA Insurance Group are different. They have a reputation of putting people over profits and always doing what's best.
If you need life insurance or disability insurance, reach out to Pradeep and his team today. They will help you get the insurance you need with the service you deserve.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.